Okay, so in this section of the presentation, we'll be talking about what is protected investing and why is it a better retirement solution than using bonds. Again, this is part 3 of 4 of our presentation, in our presentation on how do I increase my risk-adjusted portfolio returns and minimize taxes as I plan for retirement. So let's kind of just jump right in. What is protected investing? Protected investing is simply protecting against losses on your portfolio return while getting most of the upside. So just let's summarize a couple key characteristic of it is when you're utilizing protected investing vehicles, you are protected against losses in exchange for giving up a share of the upside. So again, whenever you get a benefit, there's a cost to it, and that's the cost, right? But the upside here is you're reducing the volatility. Also, the returns are either tax-free or tax-deferred. So you're getting multiple benefits in exchange for giving up some of the upside. You're making the vehicle itself or the returns more tax-efficient. And again, you're protecting against volatility from protecting against losses. So now let's kind of just quickly talk about, well, what are some examples of protected investing? What vehicles are they? And here's just a list of a couple of them, right? No commission annuities, multi-year guaranteed annuities, whole life insurance, indexed universal life, and structured notes. So now I'm just going to use an example of one of these vehicles, the indexed universal life, where how it works is you get a part of you get a part of the index return subject to a spread. So in this case, you're getting the return minus 8%. And it's floored at 0%, so you're not getting any of the losses. So we're just going to look at examples of what you'd be earning here. And again, these are kind of hypothetical. So here's your S&P total return for year 1. It's 14%. If we subtract the 8% spread, you're getting 6%. Year 2 is 4%. We subtract the 8% spread, that's negative, so it's floored at 0. You're getting a 0% return. So again, you're protected from losses. Next year is a negative 30%, a huge drawdown, but you're not taking any of the losses. Again, it's floored at 0. Year 4 is 25, the 8% spread, you're getting 17. Year 5 is 9, you're getting 1. So we can see here the downside is that you're not getting the full upside here of the S&P, but you're protected against losses. So what this is doing is reducing volatility. And the other thing, the benefit of the IUL is that they make these returns tax-free. So again, you're giving up something, you're giving up part of the upside, but you're getting less volatility and more tax efficiency. And we'll see how that translates in relation to bonds, in the next few slides here. So now let's compare, right? Let's compare, stocks, protected investing, and bonds. Again, we should be familiar with this from the previous presentation. The blue line is S&P return, your equity. The red line are your bonds, and then the orange are your protected index return. Now, a key thing with this chart is that it's after-tax returns, right? Because we're, in the previous slides, we just talked about pre-tax returns, but one of the real benefits of protected investing is you get tax deferral benefits or tax-free benefits. In the case of the IUL, you're getting, that we saw before, you're getting tax-free return. So let's kind of look at it quickly. We'll compare the protected investing to the equity market, and then we'll compare it to bonds in a second. So with regards to the equity market, again, here's the blue line. We can see that it tracks very closely, right? So the correlation is high. But what are we seeing here? We're seeing that when the S&P is negative, the protected investing, it's floored at 0. You're getting 0, and it's less. And then in most years in which it's positive, right, and the protected investing is less than the equity return. And we see that for most cases. You might say, hey, Rajiv, I'm noticing in a couple of years, the protected investing is actually higher than the equity investing. And that's because of the tax savings. Remember, the protected investing, you're getting tax-free returns. So even though it's a spread of what we assumed was 8%, that spread is not nearly as much as the tax savings. So in certain years, the IUL is actually outperforming the equity returns. We can see that here in 2013 and 2019. So we can quickly see that it's a high correlation, obviously, to the S&P or the equity markets, but it has advantages that it's protecting you for the loss, right? Like in 2008, you're not experiencing the loss here. And in certain years, you're actually doing better. However, when we compare it to the bond index or the AG, we can see that it drastically outperforms it, right? So because you're getting floored at 0, but you're getting a lot of the upside of the equity markets. So again, it's reducing the volatility and making it more tax efficient than bonds. And we'll see that when we look at the after-tax returns in this chart on the right. So this, again, this table should be familiar. We looked at it on a pre-tax basis on the previous slides, where we have, again, stocks, which is the VU. That's the benchmark. The protected index is the IUL, and then bonds, we're using the AG. Again, we're going to look at the pre-tax return, the after-tax return, and then the after-tax volatility and after-tax Sortino ratios. So again, from 2002 to 2021, stocks, again, did well. Compound annual return of 9.33. Protected index, the pre-tax return is 7.94, and bonds were 4.15. Well, now let's look at on an after-tax basis. Again, we're still using that married couple, making about $450K a year. So we can see that on an after-tax, this is about 6.61%. The protected index is actually the same, right? Because as we talked about, the pre-tax and the after-tax are the same because it's tax-free. The returns are tax-free. So in this case, from 2002 to 2021, the protected index actually beat the stock market on an after-tax basis. And we'll talk about in a second why that's unusual. But if you actually look at it that way, that's the actual after-tax return. Bonds, on the other hand, when we look at the after-tax, again, tax inefficient. Again, you're not really making a whole lot off bonds. And then if you're, again, have a financial advisor charging their fee on top of this, you're making even less. And the next thing to take into consideration is the volatility. How volatile are these returns on an after-tax basis? We can see that, again, for stocks, it's fairly high. The protected index, it's also relatively high, not as high as the equity market, but definitely a lot higher than bonds. But when we look at our return to risk ratio or after-tax Sortino ratio, we can see that of the three, the protected index has the best after-tax return to risk ratio. And that's why, again, it makes protected investing can make a lot of sense for your portfolio because, again, it's protecting against the downside and it's making it more tax efficient. So if you're really looking for a holistic portfolio solution, using protected investing in place of bonds makes a lot of sense. Again, just to summarize, protected investing provides greater risk-adjusted after-tax returns than bonds. I will mention here, you might be realizing, wait a minute, protected investing is greater than equity markets, and that's actually not the case in the long term. The only reason that during this period, protected index or investing outperformed equity markets on an after-tax basis is simply because of 2008, right? Like, there's such a huge drawdown that it hurt the returns here. But if you actually simulate results, we'll see that in the next slide. What you can expect is that stocks are going to have the highest risk to return or return. Next is the protected index, and then bonds will be last. So we're going to see that in the next slide. Again, this is based on simulations, not on any historical time period. Again, we're going to use the assumption stocks are about 10%. That's kind of the long-term return profile of stocks. We're going to look at the compound 30-year pre-tax return. The protected index, again, it's only about 4.38%. Bonds, we're using about a 3.5% assumption. And then when we look at the after-tax, compound annual after-tax, we can see that stocks are about 6.98%. Again, protected index, the after-tax returns are the same, right? Because it's a tax-free vehicle. Bonds, again, you're not really making a whole lot on an after-tax basis. When we look at the 30-year after-tax volatility, right, after 30 years, the volatility is lowest, obviously, for bonds, right? You're not going to see it's going to, be within this kind of mean of 1.58%. So that it has the lowest volatility bonds, but protected index returns, are again the volatility is not as low as bonds, but lower than the equity market. And when we look at our, return relative to risk ratio, our after-tax ratio, again, stocks outperform, but using protected index vehicle is going to vastly outperform bonds. So again, over the long term, equities should provide better value than protected index investing in bonds, but protected index investing or protected investing is going to be a better solution for portfolios than utilizing bonds as you get near to retirement.